Welcome to the Economy Magazine. I'm Binyamin Benyamin with the top stories in the global economy. Coming up today, automated trading gains popularity, and Ukraine faces stark economic realities. First, look at the headlines. The yuan fell on Tuesday by the most in a single day since 2012, raising expectations China's foreign exchange regime may be modified. The yuan dropped 0.35% against the dollar in the onshore market by midday and has fallen 0.7% since Wednesday. The People's Bank of China sets a rate against the dollar around which the yuan is allowed to fall or gain by a maximum of 1%. Analysts believe China's central bank is behind the drop in the yuan, which reached record highs in late January. The daily trading band was last expanded from 0.5% in 2012, and many expect the bank to further widen the band to curb the currency's appreciation. Germany's economy strengthened in the fourth quarter, underpinned by foreign trade. The economy grew by 0.4% in adjusted quarterly terms and 1.4% in adjusted annual terms. Exports grew by 2.6% on the quarter, while imports grew by only 0.6%. The trade surplus added 1.1 percentage point to quarterly GDP. Business confidence in Germany rose to a 2.5-year high as a survey of 7,000 companies showed businesses believe 2014 will be a strong year. Donors pledged a total of 8.8 billion euros to help fund Senegal's economic and social development plan. Senegal is one of West Africa's most stable democracies, but the government is under pressure to create more jobs and diversify the economy. The funds will help finance development over the next 4 years. The development plan aims to boost output from agriculture, fisheries, and agro-industry, as well as the mining sector and tourism. A more ambitious 10-year plan called Emerging Senegal would cost $21 billion and target doubling growth, currently at 4.6%. Talks between 12 nations negotiating the Trans-Pacific Partnership have ended in Singapore without reaching an agreement. An official involved in the negotiations said, "Progress has been made, though a final agreement remains elusive." The ministers involved in the talks are considering holding the next ministerial meeting in May, though the timing of a completed deal looks increasingly unclear. The deal aims to cut tariffs and set common standards on trade issues across the countries that cover almost 40% of the global economy. Long-running differences on tariffs on imported goods, particularly between the United States and Japan, are proving difficult to overcome.
Japan and the United States are relatively the largest economies of the 12 trading nations here. And it's said that it's important that the U.S. and Japan at very least reach some sort of breakthrough. That is true. We are working heart and soul to make that happen.
And JP Morgan Chase plans more job cuts in its mortgage business as demand for home loans plunges. Several thousand job cuts are planned on top of the 13,000 to 15,000 positions already due to be slashed. Rising interest rates have stifled demand, causing the biggest banks to cut tens of thousands of positions over the past 2 years. JP Morgan is also looking to cut thousands of other jobs in branches over time. As the world is increasingly run by artificial intelligence, a growing number of companies seek out algorithmic trading. Natalie Ehrlich has more in the next report.
Emotion, greed, arrogance. Imagine you could take the sin out of investing. Well, perhaps you can with the help of a machine.
A lot of times when people trade, they let their emotions and feelings get in the way. It might be a good idea sometimes, but usually not. And the computer doesn't do that. I mean, it has its rules and it only trades according to them.
Welcome to the world of algo trading. Instead of relying on a market trader, or even worse, the caricatures depicted in Hollywood films, in some cases, you can remove human intervention altogether. A pre-programmed algorithm decides what stocks to buy and what to sell. It's unfazed by market swings because, after all, it's based on math. A growing number of hedge funds, investment banks, and pension funds are turning to automated trading, as it's also called. We got the chance to sit down with I Know First, a financial startup that has innovated a self-learning algorithm based on artificial intelligence and machine learning. Dr. Lipa Reutman, a PhD in chemistry from the Weizmann Institute, with 20 years of experience working in artificial intelligence, says the mathematical model that describes chaotic chemical processes found in nature is similar to the model of financial markets. He's so convinced of the similarity, he even created an algorithm that incorporates aspects of genetics.
It's used for very difficult processes where the exact rules are not known and even probably not existent, but it allows us to come up with pretty good approximation of what happens next in the market.
The algorithm offers 1,400 predictions per day for 6 time frames for the short, medium, and long term by identifying waves in the stock market to forecast its trajectory.
Our return in 2013 was 60%. versus the 29% of the S&P 500. We were beating the S&P by 31%.
But algo trading is competitive. As it becomes more common, it's even harder to make a profit using it, cautions Yair Koren, an algo trader in a hedge fund which partners with Harel Insurance in Tel Aviv. The rapid growth of automated trading, as well as several cases of algorithms gone wild, have caught the attention of market regulators across the globe. The fear is that an excessive number of computer-generated orders in a short time could cause violent market volatility. The 2010 flash crash, in which the Dow Jones Industrial Average plunged about 1,000 points only to recover those losses within minutes, was largely attributed to a type of algorithmic trading known as high-frequency trading.
Eventually there's going to be a really bad flash crash, and then we're going to actually get something done. But at the rate we're going right now, something bad will have to happen before the regulators will do what has to be done.
There's also a concern of lack of transparency, which gives traders an advantage over retail investors. Still, some algo traders like Yair Koren are not so sure the flash crash is a result of algorithmic trading. In fact, he thinks algo trading helps balance the markets.
Algorithmic traders usually add volume to the markets. And when you add volume, you make the spread lower. You make the difference between buy and sell prices lower because there are a lot of players, a lot of people who want to buy and sell. So I look at it as a good thing.
We're joined now by i24 News reporter Natalie Ehrlich and Amit Tesler, economics reporter from Israel's Globe's financial newspaper. Thanks for joining us. So, a trader on Wall Street or anywhere else, I mean, he has all kinds of information available to him in terms of the weather forecast, in terms of the political situation, and with all the information, he can then do the trade accordingly. Can an algorithm do the same thing? I mean, is it a good thing?
Well, hello, Benjamin.
Yes.
A trader in Wall Street is a human being, after all. An algorithmic trading system is a computer that uses a rule of thumb in order to gain advantage in the market.
Right.
In what way? Suppose that you're a trader, okay, and you want to go out for a vacation. Now the software can do the job for you. If you write down to the software a rule of thumb of, let's say, you buy if a certain stock declines 15%, okay,
right,
then it'll do the job for you while you're in a vacation, exactly in the very in the minute when the stocks declines. Okay.
So it makes it easier, so the person doesn't have to sit in front of a screen, but it takes away the intuition, so to speak, that the trader has.
And it also reacts very fast, in a matter of seconds, milliseconds.
Right.
It goes. High-frequency trading is something that you buy and sell all the time in order to gain little amounts of profit all the time.
Okay, Natalie. So what, in your view, are the pros and cons of algorithmic trading?
Well, this certainly is a very controversial debate that's happening all over the world. And particularly, we just saw that the algo trader, Yaron, he spoke about, is that one advantage is that the spread of the offer and the bid can tighten and therefore balance out the prices in the market. So in a sense, it helps equalize the prices, and that could be a benefit for all people, including just retail investors like you and me. A negative, though, that can happen is that on the short-term basis, and Ted Kaufman, who I spoke to, former senator of Delaware, said that because the computer generates these orders so quickly, they're able to scoop in on the prices much faster faster than your average person. And so that creates some kind of disadvantage for the average retail investor, which he, like many regulators, believe is almost like a form of insider trading.
But then there's more and more people getting into algo trading, which then more or less levels it out, isn't it?
Exactly. So there, on one sense, because this is why it's generating so much debate, on one sense, the added volume of high-frequency trading helps balance out the prices, but still they're scooping in first to get the lowest price. And so that's creating the unfair advantage.
I see.
At the same time, this is really interesting because I think more or less, the growing consensus is that for short-term investors, high-frequency trading in particular poses the most risk.
Right.
Why? Because when there are market dips that happen generally in the stock market, the machines run for the hills. It's almost like it's almost like crowd thinking. They all run, and it exaggerates the market dips.
I see, right. Just
And so
like you
that's,
saw in the flash crash, right?
Exactly. And so on the short-term basis, when the flash crash happened, that's very bad for short-term investors.
Yeah.
But in the long term, it does balance out.
I see. And what is the Fed's reaction to this?
Well, this is an actually interesting component with the Fed. I spoke with a guy named Rob Friesen. He's a normal market trader back in the States. And what he's saying is that the Fed, with its quantitative easing program, has served as a backstop for these kinds of events, almost like as an assurance for retail investors to put their money in the stock market.
Yes, I agree absolutely with you, and I can also add that I think that regulators usually would like algorithmic trading. Why? Because it increases the volume of trading, and they earn more money. They charge more fees over the volume of trading. That's why they like it.
Okay, well, where's algo trading used? I mean, it's obviously used a lot in the States. I mean, are there other markets that are taking to it around the world?
Well, it's very common here in Israel too.
I see, yeah.
In bonds, it could reach even 20% of the total volume of trading.
Okay.
But it's not as high as in the U.S.
Okay. Not as high as in the U.S.
Yeah, I mean, this is a global trend, and regulators from all over the world are actually looking to limit the effects of this kind of trading, and especially Europe. Even Ted Kaufman, he was saying that he thought the U.S. was behind in regulating this kind of trading.
Okay.
I think what it also does, it could increase the risk of high volatility.
Yes.
For example, I think you mentioned it in your report that in 2010, in the month of May, there was an event that was called the flash crash, in which the major indexes fell down 9% immediately, then recovered immediately up 9%. And for no reason at all. That happened because of the algorithmic trading systems.
Thank you very much. We're going to have to move on at this point. Thank you very much, Amit Tesler from Globes, and of course, Natalie Ehrlich from I24 News. Moving on to Ukraine, where the domestic solution to the political crisis leaves it to tackle the economic predicaments it faces. Let's see the next report by Anthony Lesmy.
The crisis in Ukraine is far from over. The barricades have yet to be lifted and battles remain on the horizon. While the pro-Russian President Yanukovych has been ousted from power, the Ukrainian economy is still largely dependent on Moscow. Besides gas supplies from Russia, in late December, Putin promised Kiev $15 billion in aid to avert defaulting on loan payments. But last week, the Kremlin suspended the payment of $2 billion, and London hopes to find common ground with Moscow.
We are in constant discussion with Russia, and it's very important we keep that up, particularly if there is an economic package. It will be important that Russia doesn't do anything to undermine that economic package and is working in cooperation and support of it.
It's certain the Ukrainian budget will be in the red, and they are seeking $35 billion in aid. The central bank sold a portion of its reserves and fell to just over $18 billion, the equivalent of only 2 months of imports. The budget deficit exceeds 7% of GDP at this point, and the local currency, the hryvnia, fell 9% in 1 month. And now there is an added anxiety of an upcoming double-digit inflation, a worrisome situation.
The mission of the new government is to stop Ukraine from heading into an abyss, stabilize the exchange rate, guarantee the timeline distribution of wages, pensions, and aid, return the trust of investors, help the development of business and the creation of jobs. Another priority is returning to the European integration course, the fight for which Maidan started with.
за яку починався Майдан.
Brussels has ensured an immediate assistance of €610 million to be granted to Ukraine until the EU member states discuss additional funding. The IMF, for its part, has assured that it will assist too.
So if the Ukrainian authorities were to ask for IMF support, whether it's policy advice, whether it's financial support together with economic reform discussions, obviously we stand ready to do that.
After the missed opportunity of the 2004 Orange Revolution, the task of breaking with the history of corruption and nearly unrecognizable lines between business and politics remains.
That's it for today's edition. Thanks for watching. See you again tomorrow.